as TSF Properties, 1031 exchange, and also speaking about the state of the economy. I'm sure we're all going to love to hear that. He is wonderful. He spoke at our meetings in the past. We've got videos of him up there doing all kinds of great things. I think you will really enjoy what he has to say. And if you run into any technical details, I'm your host of Technical Solutions after working 26 years at the university providing tech support, right? I've got a son now who's, pushing 30, and he's been in some of the meetings doing the videos that my friend John is doing now, and John and I go back to the 70s, so we've been old friends, as you can tell.
Don't use that word too literally, okay?
Right. And he's helped me with some technical issues, and I went, oh, finally, I've got somebody on my team, So, I think we're ready here, getting close, rusty, and I guarantee you, you're going to enjoy what he has to say. He's fantastic. And if you run into any technical problems, just wave me and I'll run back up here and see if I can help you out, okay?
You know what? Somebody closed my
Your PowerPoint? Okay.
I have to get on the internet here to get it done.
Okay, now, you think that his PDF is on your computer?
No, I've got it.
You got it, okay. Okay, so let me know if you need help.
Oh, here we go.
There you go. Yeah, we've got, I think Internet Explorer is up and running with a password. Each time you run in with another web, like Chrome or whatever, you might need to put the password in. If you say, Dan, just get it working, we can do that too.
There we go.
Yeah, cool.
I saved it.
Working at the university was fun. 26 years until they say you need to be a policeman, not Santa Claus. And I went, I'm gone. See you later. You okay?
I'm up and running.
Thank
you. Morning, everybody. Good morning. Another beautiful day in Southern California. Yeah, my stepson has a ranch up in San Diego. So I was up there and I drove down here this morning, and it's kind of nice. I live in LA, so. Sorry. It has its pluses and its minuses. I get it.
It's not a long
I live up in the mountains. It's very beautiful, Pasadena area. But yeah, you're right. Well, I'm from Canada originally, and I always tell people like LA's like the best and the worst of everything you can possibly imagine smushed together. Right? You literally go 2 blocks, it's a whole different world. So you have to pick your neighborhoods. But anyway, so we're here to talk about real estate, and we're all kind of scratching our heads right now, wondering what's going on, where's it going to go, and so there's a lot of questions, and I don't have all the answers, not by a long shot. But I do know how to look at properties, and if you're dealing with income property, there's always deals out there. And right now there's some really good deals we'll be talking about, but there's always stuff going on. Truthfully, when the market slows down a little bit, it's actually more fun from the deal maker's point of view, because now you can make deals. Whereas before, when the market's hot and you put a property in the market and it's gone in 3 days, you can't make a deal. There's no deals. It's impossible, But I was just on a call the other day with some. Believe it or not, a friend of mine, we're just doing a transaction in Las Vegas, and he's a broker, and we were joking. He's 91, and we're using him as our broker for this transaction. We're doing a big medical building there. And anyway, he's joking about, he's had his broker's license for 65 years.
Wow.
But he's, over all those years, when you get into a slower market or whatever, he's giving me all these ideas how to do creative financing and getting the seller to pay back money. There's a lot of things you can do when the market slows down that nobody wants to hear about when the market's hot. So you can actually do some very interesting things. So anyway, just to give you a quick outline of what we do, we're a commercial brokerage in LA. We're focusing on income properties. If you know anything about, well, I'm sure it's not much different here actually. If you're looking at income property in California in general, you're looking at very, very low cap rates, right? Like you're making 2, 3, 4%, maybe 5 if you're really lucky. And in the world I live in, we're like 5 is way in the low end, right? We're looking at 5 to 10 or sometimes 12% cash flow. And so to get that, you have to go out of California, to be frank. So our big focus is working with people that are selling property here in California, and we transfer that money through the 1031 exchange process into properties in other markets. And I'll be kind of talking about that. But yeah, we routinely double or triple people's income doing that. So it all depends what you're trying to do. Every investor has their own game plan, but that's our game, and it's done very well for us, and our investors have done really well also. Again, we do we'll go through, but we do commercial, we do a lot of single-family rentals as well. We do manufactured homes, and we also do investing for clients through their real estate, through their IRAs. And here's my guys. We have probably 5 different languages in our office. That's LA for you, right? Anyway, so our mission is to provide our investors with strong, reliable cash flow, and we do that by intelligently using 1031 exchanges to reposition people's portfolio, basically, into higher income property in other markets. Now, you don't have to do a 1031 exchange to deal with us. You know, we do a lot of investing for clients outside of 1031, but I would say at least 70% of the transactions we do are 1031 exchanges. Yeah, and when we're doing properties, especially when they're out of state, we want stuff that's easy to manage for you. So we have local management set up in the markets we deal with, and so you don't have to worry about it. Pretty much all the stuff we're doing is turnkey. And again, we'll talk about that as we go along. But we do a lot of single-family rentals. For those of you that deal with apartments, like I mentioned before, cap rates are very low in apartments. Everybody wants to buy apartments, multifamily, and it's not just here in California, it's all over the country. So any kind of good quality multifamily, there's a lot of buyers for, even now, even though things are slowing down a bit. And so we're finding that if you put a portfolio together of single-family rental properties, the income is much, much higher than multifamily. So for a lot of the stuff we're dealing with, it makes sense to buy maybe 10 single-family homes instead of buying a 10-unit building. It's a little harder to manage, but the ultimate income and profit is actually higher, we're finding. And we've done that for quite a while. We've done a lot of manufactured homes, pretty much in Texas. That's an interesting market that a lot of people don't know about. There we can get you 9–10% cash flow. Yeah, very interesting market. We've done a lot of triple net lease properties for larger transactions. Sorry?
Do you have your own management companies to help people get these things managed?
Yes. And any market that we're dealing with, we have, it's not us,
okay,
but we have a relationship with a management company locally in that region that we've worked with before.
Okay.
And a lot of these markets we're dealing with, we've been dealing, we've done hundreds of properties in these markets. So,
You're going to have to touch the screen there.
Oh.
Blanked out on you. There you go.
yeah, so anyway, so these markets we're very familiar with, and we have, a lot of, groups that we work with locally that we've had a lot of experience with. Yeah. And again, we do listings for properties, here in Southern California as well. Okay, so let's go through 1031 exchange, and just so you know, I'm going to probably go a little fast. And so if you guys want, our booth is right out there, and we'll gladly answer questions afterwards. Bob's here with me also. And also, if you want these slides, we can give us your email information, we can email it to you. Okay? So again, I'm going to be going a little fast, it's a little shorter than I usually do this. So what's a 1031 exchange? Well, you can look this up in your IRS code book. 1031 comes from the IRS code section. Okay, and it's a very, very old area of law. It comes up quite a bit that it's going to be, anyway, that it's going to change, but ultimately it doesn't change. Like every new administration that comes in, from a, presidential election or whatever, they always talk about changing the 1031 exchange rules, but they don't. And we can always debate why. The real estate lobby is one of the largest lobbies in the country, and on top of that, I think more money, more tax money is generated by doing 1031 exchanges than is lost by not having those rules. And the reason is pretty simple. How many people would sell a property if they couldn't do a 1031 exchange? Right? How many people sell a property because they can do a 1031 exchange? a lot. So most of the investors I'm dealing with, they would just sit on their property until they passed away if they couldn't do a 1031. When you do a 1031, there's a huge amount of taxes generated. You've got real estate commissions, you've got title company costs, you've got escrow fees. You know, all these people are making money and going to pay taxes. You know, you got readjustments here because of Prop 13 where they, you know, taxes go up for property taxes. So there's a huge amount of taxes generated just because of the transactions that are happening. So even though the investor who owns the property doesn't pay taxes, there's a lot of other people that do. And that transaction probably wouldn't have happened, or a lot of them wouldn't have happened if they couldn't have done a 1031. So that's a whole debate on its own. So all right, so let's just talk about how this works. So let's just say this is an example where someone bought a building 20 years ago. They bought it for $1 million. That $1 million is their basis, and that's where you calculate your taxes from down the road. And so in this case, again, we just made it simple. That building went from $1 million up to $2 million. Everybody understands that there's a $1 million capital gain, right? And you have to pay tax on that. What a lot of people don't realize is depreciation. So when you're investing in real estate, you're really happy to learn all about depreciation, right? For those of you guys who've been in the business for a while, most cases, all or most of the income you get from your rent is offset by the depreciation that you take on your tax return. Okay? And sit down and look that up if you don't really understand how that works, but you're allowed to depreciate the value of that building every year on your tax return and write it off. And that write-off usually offsets most of the income you get from your rent. Well, what happens is, over time, in this case, the depreciation over so many years was $600,000. Okay? That's the tax break that the person on this building had. Well, when you go to sell that property and you don't do a 1031, that $600,000 is now taxable on top of the $1 million. And again, a lot of people don't realize that. And so that's an additional tax. And so when you're calculating this, it's 20% on the $1 million, on the capital gain portion of it, and that's on the federal level, right? And then we have the depreciation recapture, so it's going to be 25% of that $600,000. Okay? And then in addition to that, we have the honor of being in California, right? And if it's over $1 million, you pay an additional 13%, so 13.3. Right, so it adds up pretty quick. So on this transaction, $1 million capital gain, it could easily be over $500,000 in taxes. So who wants to write that check? Exactly. Now, that's why everybody loves 1031 exchanges. And also we have one of the highest taxes in the country, and so you find that people's understanding and use of the 1031 in California is probably the highest in the country. Right? People are much more aware of it, I find, than people on the East Coast, for whatever reason. But again, our taxes are higher here. Anyway, so understanding how to get around these taxes is a good thing. Now, when I use these numbers, these are really general. You really need to sit down with your tax guy because everybody's different. People have taken different, write-offs and things over the years on their taxes. And so you really need to sit down with your guy. One thing I always tell people, a lot of people that I've been around for a while have losses on their tax returns from years ago, right? Like who lost money back in 2008, 9, and 10? And so you get what's called a carry forward loss. And that loss continues indefinitely on your tax return. And so a lot of times people, when they sit down with their tax return, they probably didn't realize it or they forgot or whatever. They go, wow, I had a $100,000 loss from years ago from a business I had or something. And you could pull $100,000 out of this transaction and pay no taxes, right? And offset that loss you had years ago. So that's why it's really important to sit down with your tax guy and figure out your situation. It's different for everybody in this room and it's different for every transaction. But these are the general numbers. Okay, so how do we get around this? Well, the first thing you have to have is what's called a qualified intermediary or an accommodator. Same thing. And they're sort of like an escrow. Okay, so when you close escrow, you can't take that check. Okay, you have to have it set up ahead of time that when you close escrow, the money goes to an accommodator. Okay, and accommodators there are specific companies set up just for this type of transaction, and they hold the money for you until you complete your transaction. And if, for those of you who have ever done like a 401k rollover or an IRA rollover, it's the same kind of concept. If you take the money personally, you have to pay tax on it. But if it goes from one institution to another, in this case an escrow to the accommodator, there's no tax, okay? And the accommodator's job is to kind of police that whole transaction. So if you ever get audited from the IRS, you've got someone that said, yeah, he never touched the money. It went from this account to this one, and then we just distributed the funds to the new escrow. Okay, so very, very important though, you have this set up before you close escrow. Now, I belabor this point because I've had it happen several times. In fact, it happened a year ago, and I was kind of shocked. I had a client who I'd done other transactions with before, and he knew the score, but he got older, and I guess he just forgot, and he came into my office and said, look, I closed on this property, I want to do a 1031, here's the check. What do I do? It's too late. We tried to figure there's some angle on it. Maybe they could cancel the check and reissue, but it doesn't work that way. Once that escrow closes, the escrow company has to issue a 1099, and you can't go back and change that transaction. So anyway, that's why I kind of belabor this point. Before you close escrow, this has to be set up. All right. Timing is of the essence. When you close escrow, that's day one, and the clock starts ticking. You now have 45 days to actually close, you have 45 days to pick the property you're going to buy. You don't have to close escrow on it, you just have to pick it and identify it. So literally, on the 45th day, there's a form you have filled out with the accommodator, and it will lay out the properties that you're planning on buying. Okay, you have to have the address and the value and all that kind of stuff. And it's listed on there, all right? And then you have an additional 135 days for a total of 180 to actually close escrow. Yes?
You said properties. You can have more than one that you picked within the 45 days?
Correct, and we're going to go through that in a moment. Yeah, there's several different rules you can use depending on how many properties you want to do. But yes, you can do multiple properties. But again, you have to have these dates, in your head, big time, because that 45 days will be the longest 45 days of your life. Or actually, I'm sorry, it'll end up being the quickest. It'll go back so quick, and now when we had a hot market, it was really tough because you'd be out there bidding on properties and you got outbid and whatever all the time. Now it's a little slower, so it's going to make it easier to pick properties, but then it's still tough to, find a property that you want. But anyway, that's where we come in, where we have inventories of properties we have available for you that you can pick and use for your 1031. It's up to you. All right, so the term like kind comes up, and that's in the IRS definition of the type of property you can exchange into. And so you have to understand that. But truthfully, it's actually a very broad definition. If you sell an apartment building, it's pretty obvious you can buy an apartment building and exchange into it. But the truth is you can exchange into any type of real estate that's within the United States that's not your primary residence. That's how open that is. So, for example, you can go into a parking lot. We actually did a big parking structure for some clients of ours in Cincinnati. They sold some land in Los Angeles, and we found this other property for them in Cincinnati. Single-family homes, like I mentioned, we do a lot of single-family home investment properties. That's totally fine as long as you're not living in it. Oil and gas. We've actually done oil and gas transactions, transferring property from here into land deals in Texas. Yes?
Can a family member live in it?
Yes. Yeah, as long as they're paying rent and they're treated like a third party. Yeah. Medical, in fact, we just closed on a medical building yesterday in Vegas. It was the largest LASIK center. It was like a $6 million transaction. And so that was a triple net lease deal. And our client sold actually an apartment building in LA. Raw land you can exchange into, triple net lease properties, storage units. Any combination of this works for a 1031. Okay, it's a very, very broad definition. But it has to be within the United States. We can't go outside. Yeah, just examples, more examples. Commercial buildings. We actually did an In-N-Out Burger. These things all qualify. What doesn't qualify is a property that you live in yourself, obviously. If you're developing property or doing fix and flips, like our first guy here was doing, you can't do those as 1031s. Okay? If you're going to buy a property with the intent of turning around and selling selling it after fixing it up, that does not qualify. You have to buy a property with the intent to hold it long-term. Now, it's pretty open what that term is, right? So it's a general rule of thumb is 2 years, okay? But there's no set rule. It's kind of what's, your CPA thinks is okay, right? But we usually use 2 years as our rule. But if you buy, like some guys buy a, tract of land and you're going to turn it into a subdivision, you can't do 1031 with that. There's an inventory rule where you're subbing it out and then you're, selling off the individual lots. When you're doing an inventory like that, it's treated like a regular business. You can't do a 1031. Now, if you did that and then rented out all the properties for a while and then sold them off, you can do it. But if you developed some land and turned around and sold it right away, that does not qualify. Partnerships become a kind of an interesting thing to deal with. When you're doing a partnership, the entire partnership has to go together on the exchange. You can't individually go on your own. And so, so if you have a partnership and everybody kind of wants to do their own thing, you have to break it up and everybody has to go into a tenants in common interest first. And you have to do that before you sell, before you do any kind of listing of the property.
But if it's just a share, like a syndication.
Yeah, and it depends on the syndication, how they've structured it. But most of them, I don't know, you have to look at the syndicate. If it's a tenants in common or a Delaware statutory trust, those you can take the interest and do an exchange. But it depends how they've structured the deal, and that's why I bring this up. Because sometimes they haven't structured it in a way that you can do a 1031. So yeah, be careful of that. Okay, so the question was asked, how many properties can you do? There's 3 different rules available, and I'll go through these. The first and most simplest, and probably, 97% of all the transactions that you hear about in the 1031 exchange world comes under this rule, the 3 property rule. And so the property you're selling is called your downleg. And so you're allowed to pick 3 uplegs in your exchange and put that on that ID sheet we talked about. The IRS does not care which one you close on. You could close on one of them, you could close on all 3 of them. They don't care. All they care about is you identified 3, and also they care about if you sold a property for $1 million, you have to buy at least $1 million worth of property. So the total value of whatever you're buying has to be $1 million or more, right? Equal or greater than what you sold. So again, this is really very easy to understand and use. Sometimes it gets a little tough because what it means is if you pick a property and you want to close on it and you go past the 45 days, well, you can't go back and change it. So a lot of people will put a backup offers, in other properties so that if one property falls out. And look, anyone who's done real estate knows, I mean, how often have you guys tied up a property and then you find out there's foundation problems, so there's a big problem with the roof. And, there's just issues that came up that you never, I've had it happen where, I never would have thought of that. And you have to back out of the deal or negotiate it, the guy won't renegotiate. So you're stuck. So again, it's always important to have backups, and also when you're doing an exchange, you really want to think ahead. You want to have all your ducks lined up, ahead of time, because again, you don't want to get caught after that 45 days having to change things, and you can't. Okay, so the other rule that we use mostly in my office actually is the 200% rule. And the 200% rule says you can pick as many properties as you want. There's no number. But it can't be more than 200% of what you sold. So if you sold a building for $1 million, you're allowed to pick up to $2 million worth of replacement property, and it doesn't matter. It could be 1, it could be 20. And we've done it. We've done it with 15 or 20 properties. And so, and all they care about is if you sold that property for $3 million, you've got to buy at least $3 million worth of property, and you can buy up to $6 million. Does that make sense? You're all going to pass the test at the end? Okay. Yeah. And so again, a lot of people are not familiar with this rule, but we use it all the time. We've never had a problem. It's just a matter of filling out the paperwork correctly and making sure your tax guy knows how to do the tax return correctly. But it's used all the time. The third rule is the 95% rule, and I swear, I've been doing this for over 20 years and I've never seen it used. I never even heard of it being used. It's one of of those oddball rules that were plugged in, you know, when they first passed the tax rules. And I don't know what they were thinking. It says that if you can do as many properties as you want, but you have to close on 95% of what you pick. So when you think through the logistics of that, it's really tough. And so I don't know where that came from, so we're not going to worry about it. Okay, one thing that is kind of interesting, comes up a lot, is what's called a step up in basis. And the step up in basis means that a property has a basis from when you buy it, and then it, you know, it changes over time depending on when you depreciate it or put more improvements in that property. And again, that's something, you know, you get from your tax guide. But when somebody passes away, they actually get a step up in basis, right? And what that means is, if some, you know, let's just say your parents bought a building for $1 million, and today it's worth $2 million, and your mother or father passes away, that building is now reappraised at the value. Let's just say your father passed away. You now get that valuation done at $2 million, and now that's the new basis. And that means that your mother could sell that property and pay 0 tax. So there is no capital gains tax when somebody dies. Now, there is inheritance tax, which is a whole different calculation, and I believe right now that's about $5.5 million per person. So a family can go up to like $11, $12 million right now and pay no taxes on inheritance. But as far as step up, and what's also kind of interesting is the survivor, which could be the mother or it could be the kids, whoever inherits this property, can depreciate that building all over again at the new appraised value, which is a huge tax advantage for the survivors. Yeah, so that's kind of a cool thing. But unfortunately, somebody has to die to get that. But it is in the tax bill. Okay. Let's talk about some of the pros and, well, I think the big pros for 1031 exchanges. When you're doing a 1031 exchange, like I talked about earlier, a lot of the people we're dealing with, they're going, you know what? I have this property in California, I have other properties here as well. I want to do something different. I want to get some of my money outside of California. I want to get higher income. I want to get into a different type of property. You know, there's a lot of different reasons why people want to do something like this. But it allows you to diversify. And so when you talk about diversification in the real estate world, there's really 2 things. There's geographical diversification, right? So you go to California, you go to Texas or Florida or whatever market you want to go into. And also by the type of property. So most people are very familiar that we deal with having single-family home rentals or multi-family rentals, but they're not familiar with triple net lease properties, for example. We do a lot of triple net because the nice thing about a triple net is you can go out of state and you don't have to worry about it. On a triple net lease property, all the management is really up to the tenant. For example, well, this is a Popeyes we did a couple of years ago. That was in Riverside, actually. But that owner of that property that we did the transaction with, he doesn't have to worry. The Popeyes is going to pay the insurance, they're going to pay the property taxes, and they're going to do the maintenance. So if the air conditioning breaks or the toilet's back up in this building, the tenant legally has to handle that. And so for any kind of fast food or larger commercial properties, that's really common. Like I said, we just closed yesterday for a client on a big LASIK surgery center right in Vegas. It was a triple net lease for like 15 years. Our client sold some property here in LA and they're like, it's great. They don't have to worry about it. They're going to get 6.5% cash flow off that building for the next 15 years on that lease. And they'll probably renew and keep it going. And they're going to have no management worries because, again, the on-site tenant is going to do all the maintenance. And so it's a very easy type of property to manage. All right, let's go next slide. All right, let's talk about economics for a little bit. And again, it's the jury's out on this one. We're all kind of, I'm asking people all the time that I know, you know, they're out there doing transactions or whatever to find out what's happening, and it's kind of interesting. There's still transactions happening, it's certainly not dead, and it seems to me overall property values around the country are down maybe 10%, depending on the market you're in. I know that in LA, the number of transactions for single-family homes is down almost 50%. That doesn't mean the prices are down that low. It means that the volume is down. Now, when the volume goes down that much, you're going to see some price reductions. But the truth is that overall, the inventory is still really low, and there's a lot of people that want to buy homes. And they got pushed out of the market because the interest rates went up and they couldn't qualify for the debt. And so now's the time for more creative financing and things like that. But ultimately, there's still a lot of demand out there, and there's still a lot of money. We do have the highest inflation. I was just listening to a thing today about eggs. About how they've gone up a lot. It's almost $1.50 an egg right now some places.
Wow.
Yeah. But that's kind of compounded because there's inflation. Also, there's some kind of avian flu going on out there, killing off a lot of chickens around the country. Anyway, we do have inflation, and that's also affecting things. That's forcing the Fed to raise interest rates. How long they're going to keep them up there and whether they're going to keep going up, we don't know. It's something we have to be aware of, and it's something we have to factor in our thinking when we're buying or selling a property. But it's something we can't control, but we need to kind of watch it. So back to the inflation rate, you can see that it's actually been dropping a little bit. I know the White House said, oh, inflation, we got it under control. Well, it's still high, it just dropped a bit. It's not going up anymore. So we'll see where that goes. But in the end, when they've printed all this money that they did during the COVID period, et cetera, that money's circulating out there and it's going to show up buying things, Anyway, and here's a chart of interest rates. Now, what's kind of interesting, okay, so right now we're around 6%, right? Which is probably an average for going back many, many decades. When I bought my first home back in 1981, and I paid 12% interest on the mortgage. It was just normal back then. Now, prices adjusted, right? You couldn't, that home today is worth probably 8 or 10 times what I paid for it back then. But anyway, the point is that around 6% has been kind of a norm for interest rates. Getting in that range, I'm not worried about it at all. It's when it gets above that we start getting concerned. So hopefully they don't raise the rates much more, if at all. But again, when you go back in time, around 6% is kind of a normal number, really. It went down too low. And so a lot of people got used to like these 2 or 3% interest rates, which those are crazy numbers. It's great when you're borrowing money, but it was too easy money. And so now we're kind of going back to a normal market. But again, if interest rates go much over 6%, I don't think that's good. This is a volume of home sales, and then it's down. You can see that the peak we had up here was around, I think it was around 4.5 million home volume, and now we're down to about 3.6 million homes being sold. So it has dropped nationally, and it wouldn't surprise me if it dropped a little more. But it's still not terrible. Again, like I said, we went through a market where you put something on and you turn around and sold it, in days or weeks. That's unusual. That's not the norm. When you go back in time, a normal market is 3 to 6 months to sell a property. And everyone's going to have to readjust their thinking because that's a normal market, 3 to 6 months to sell a property, not 3 to 6 days. And so we're kind of going back to, a normal market. Now, hopefully it doesn't keep going, but I think there's enough economic, that the job rates have not gone, are stable, right? We don't have high unemployment, and that's probably the biggest factor. If unemployment starts spiking up, then people can't buy a home, right? But as long as employment or unemployment is low, then people can buy, right? And again, there's going to be more creative financing and stuff like that that allow people to buy that they maybe can't right now. But in the end, there's still transactions going on. The inventory out there for purchasing is still low. There's not as much, and there's still a lot of people that, I look at my kids, and they're in their late 20s, early 30s or whatever, and they all want to buy a house now. Whereas 10 years ago, they were all living in apartments, and I think going through COVID and everything else, you know, they started realizing, do I really want to be in an apartment and work from home? I'd rather be in a house and I can have a backyard and start raising a family and stuff. So there's a huge push right now for buying homes. It's just a matter of them qualifying. And so that will, I think, adjust. So I'm not worried about a crash right now. I think it's just going to be a soft landing. So here we're showing that the volume of sales has dropped, but again, we had a crazy high. You know, we had the